Hello, welcome back to Accrued Interest. Today, March 11th, 2025, we're going to walk through the investment case for FuboTV, a favorite of FinTwit. A big reason why I did this podcast is because I wanted to focus on fundamentals and value investing. My background, aside from working in the buy side, I also have almost a decade of experience on the corporate side, specifically in television, broadcast television, cable TV, as well as US radio. So for this podcast, I'm going to be walking through the strategic implications of the recently announced merger between FuboTV and Disney's Hulu plus live TV segment that are going to be combining into a new company. As always, just let me start with a disclaimer that everything said on this podcast is for entertainment purposes only, as I am not a registered investment advisor. For those of you watching along on YouTube, a lot of the visuals that I'm going to be showing on the screen are clipped directly from FuboTV's investor relations deck that they posted on their website back in January when they announced the merger. So, you might not have been aware, but back in January, FuboTV announced that they were going to be combining with part of Hulu. A few highlights of the deal. Fubo is going to remain a publicly traded company. That's why we're analyzing it today, and not Disney. Disney, on the other hand, is going to own about 70% of the newly created entity. Fubo and Disney are going to enter into a new carriage agreement. That's a fancy legal term for they're going to have a new agreement on how much Fubo is going to pay Disney for their cable and sports channels that they're putting on this service. The reason why FinTwit and many people online have been talking about the stock is because since the deal was announced, the stock has gone to the moon, as the kids say. Before the deal was first announced, Fubo was trading, as you can see in the chart here on YouTube, anywhere between $1 to $2 a share. After the announcement, the stock skyrocketed straight up. It reached a peak of about $5.50 a share, and then during the broader market sell-off over the past month, traded down from $5 a share to $4 a share, and it sits around $3 a share on the afternoon of March 11th, which is when I'm recording this podcast. Just a couple high-level statistics, just to give you a sense of the scale of the new entity. Hulu plus live TV business is significantly larger than Fubo TV. So Fubo is going to be increasing its scale by more than 2x. Fubo's North American subscribers are going to go from about 1.6 million to over 6 million in the new co. Its revenue is going to go from about $1.6 billion of annual revenue to over $6 billion. But the growth profile is going to slow. Fubo on its own was growing revenue about 24% a year, namely on a smaller numerical base. But that future revenue growth is expected to be about 10% a year in the new combined entity. At first glance, many would argue it looks like Disney is just dumping their Hulu plus live TV business onto Fubo. Because after all, Disney is so much larger than Fubo. If Fubo was so attractive and this combination was such a good thing, does Disney buy the whole thing? Well, we're not going to get into the whole history between the two companies on this podcast, but what you need to know is that settling this deal was a way for both companies to settle a lawsuit that had been outstanding. As one of the terms of the merger, Disney, as well as their partners Fox and Warner Brothers Discovery, are going to pay Fubo about $220 million to settle an antitrust lawsuit. Basically, Fubo had tried to sue Disney and these other companies for antitrust because they thought that it was illegal for the companies to try to launch another streaming service exclusively with the sports channels. This service was going to be a big competitor to Fubo because Fubo has prided itself on being a little bit more sports-centric than the other video providers. So this deal puts that whole thing to rest, and now Disney and Fubo are on the same team. The deal also gives the company a lot more scale than they had before, but I think it's important to keep that scale in context. Fubo, which had about 1.6 million pay TV subscribers, you can see over here listed as Old Co, all the way on the right side of the page. It's now, with 6.2 million subscribers combined, going to be the number 6 pay TV per subscriber in America. One of our guiding questions when we analyze companies' fundamentals is this a good business? As I mentioned in a prior video, I believe that in 2020, the US economy is going to dip into a recession. If we are headed into a recession, the question of business quality is more important than ever. I believe that there is the right price for any business that can make it a good investment. But we have to be honest about the facts. I would argue FuboTV is what's known as the vMVPD. What that stands for is Virtual Multi-Channel Video Programming Distributor. In context, an MVPD, the same thing without the V, is what you would consider your traditional cable companies like Charter and Comcast and satellite companies like DirecTV. The virtual version of that are like some of the newer competitors that have come up in the last decade, such as YouTube TV, Sling, Pluto, and Philo. I want you to remember that just because something is digital does not mean it can avoid all of the problems that the analog versions of these companies also have. An issue that I have had in the past with services such as FuboTV is they are exposed to all of the same problems, all of the same secular headwinds that the traditional old school cable companies are facing. They don't have any of the structural benefits to outweigh the negatives. The virtual companies do not have a sticky customer base that they can hold on to by offering them broadband or fiber service to get internet to their home or business. Not only is Fubo exposed to the challenges such as cord cutting that traditional cable companies are experiencing, Fubo's sports-centric strategy makes them more exposed to the most expensive part of the cable bundle. Fubo does not have any original content or channels that they create for themselves. To me, it's very clear that Fubo needs this merger to happen much more than Disney. I'm not sure how much longer FuboTV would be able to survive if not for this merger and combination with Hulu. Here's an industry term that I learned working in television business that I want you to think about. The concept of an MFN is a most favored nation clause. Now, MFNs are not exclusive to the media industry. They have them in many different types of companies. When a cable company is having a negotiation with a television network and they're negotiating how much the cable company will pay the television network to carry their channels, the television networks promise to offer the same terms to one distributor that they offer to another distributor. They do this so no single cable or satellite company receives significantly better pricing or conditions than another service. This concept is an underappreciated reason why the old school cable companies have been able to stave off cord cutting for as long as they've had. You may have noticed that a lot of the digital services such as YouTube TV or even Fubo are not that much cheaper than your traditional video packages over cable. The reason why is because the old school cable companies are not allowed to offer the new digital video providers the same channels at a much lower rate than they're offering those same networks to their subscribers. This aspect has been hurting many digital video business models because while consumers have been asking for cheaper video packages, it's been very difficult for companies to offer cheaper video packages online because off the bat, they cannot price these channels at a lower rate than what they're giving their current subscribers. I mentioned all this to say we need to be very honest with ourselves in terms of how much negotiating leverage is Fubo going to have now that they are the number 6 paid TV provider. They're still behind a number of companies that are much larger and have much more bargaining resources. And because of these MFNs, it's very difficult for them to use their bargaining power to lower the pricing that they pay on a lot of these individual channels and then pass those savings on to the consumer. For those watching on YouTube, I clipped a slide from the investor deck that gives some of the strategic considerations that they want to highlight to investors. I'm going to go through these bullet points and we're just going to talk out whether these make sense. So point 1 is that the merger is going to enhance consumer choice through more video packages and more options. I wouldn't put too much stake in this because consumers already have a plethora of choices, and one extra service is not really going to move the needle in this aspect. Number 2, Fubo argues that there's going to be more innovation and they're going to be able to unlock sales and marketing opportunities now that they're working with Disney. This is something else I think we need to interrogate further because a key term of this merger that we'll get to later is that both companies are still going to be operating 2 separate apps. these separate apps are considered to be separate brands in the minds of consumers. So how much leverage, how much cross-promotional synergies are going to be had if they're still going to have a Fubo app and they're still going to have a Hulu app. Number 3, they said that Hulu plus live TV and Fubo are going to have a lot of synergies. We're going to get to the synergies later in the deck, but the thing to keep in mind is that you want to look at the synergies not in terms of an absolute number, but you want to look at the synergies in terms of what they do to the EBITDA margins, to the profit margins. What percentage of an annual year's revenue are these synergies? And are we talking cost synergies, which is basically firing people, which anyone can do? We see that with the government right now. Or are we talking revenue synergies? You have to wonder, where are these revenue synergies going to come from? And lastly, the combined company is going to have a much stronger financial profile. It's going to be well capitalized and cash flow positive. You want to have free cash flow as opposed to not having free cash flow, but we need to focus on how sustainable that free cash flow is before we get too excited. Something that the company wants you to keep in mind is that at some point in the near future, they haven't given an exact date, Fubo is going to launch a new sports and broadcasting service that's going to be featuring Disney's broadcast networks and their sports properties. So we're going to stay tuned to this because this could be an area where there are revenue synergies and where they increase the growth rate of their subscriber base. I'm going to cut a second video where we go deeper on the numbers. But for now, here are some high-level financials you need to know and how we should think about analyzing this company. The company calls out about $120 million per year in synergies. Now that might look like a large number when you compare it to the EBITDA. The company forecasts in 2026 an adjusted EBITDA of about $350 million. But if you look at the synergies as a percentage of revenue, which they're forecasting at about $6.75 billion in 2026, the synergies are less than 2% of the first year's revenue. Even if all of these synergies actually come into place, we're still looking at a business that has an EBITDA margin of about 5%. That is very thin. And that's something that can easily turn negative. The company shrinks or has a rocky period during the recession or for any other reason. So, in conclusion, some things to consider are whether or not the company will be able to hit its sales and marketing synergies if they continue to operate both video brands as separate apps. And modeling the future revenue opportunities, we're going to need more details about this new sports and broadcasting service that's going to be launching at a later date. If it's attractive, it could turbocharge subscriber growth. And lastly, given all these unknowns, in a following video, we're going to dive into the numbers and we're going to build an actual operating model to determine a true valuation, a price target at where we'd be willing to buy the company, and a price at which we're willing to pass. As always, thank you for listening. If you found this helpful, don't forget to like and subscribe to the YouTube channel. Please look at my curated playlists. I'll be putting this in a new FuboTV dedicated playlist so we can follow developments in real time. Thanks again.